Welcome to the Work From Home edition of the Market Week in Review for the week ending May 8th, 2020. My name is Julie Zhang, and I'm joined today by our Chief Investment Strategist, Eric Vistaben. Welcome, Eric.
Morning. It's good to see you virtually.
So wonderful to see you. I hope you and your family are doing well.
We are. Thank you.
So today we're going to talk about three items. One is the negative job market coupled with a positive stock market. Second is the state of the European economy and the world. And the third is the impact on the U.S. national debt. So let's start. So we've seen a massive increase in unemployment. What does this mean for investors in their actual portfolios?
Yeah, so I think both the facts that you mentioned, that a horrible non-farm payroll, epically bad, historically bad non-farm payroll report came out today in the States. We lost 20.5 million jobs in April, and unemployment is now just shy of 15%, which is kind of unimaginable, 14.7%. The stock market, open trading at about up 1%. So I think that reconfirms what we've been talking a lot about as we've gone through this crisis, is that April was going to be, in our opinion, largely a month of lots of data, not a lot of news. It's not, something is not news if you expected it to happen. And I think that's really the way to think about this jobs number. We knew by the jobless claims that we've had, 33 million jobless claims over the last 7 weeks. So we knew April jobs numbers were going to be horrible. March wasn't particularly good. April's are horrible. May's probably won't be very good. And we seem to probably be petering out in some of that, hopefully, in terms of the negative effects. The good news in the jobs report is that the majority of those workers actually indicated that they were furloughed rather than their jobs were kind of permanently lost, which is really consistent with this theme that we've been talking about, that the government relief, the fiscal spending, and the Federal Reserve moves have all been in an effort to make sure that companies don't go out of business as a result. And really, it isn't saving the shareholders. It isn't saving the company itself. That is the objective. The goal is to save jobs. So, back to those furloughed workers, that when we actually get into a stage where we're recovering and the economy is beginning to reopen, which it looks like we're beginning to see that in at least some of the states in the United States. We're beginning to see it in some of the countries in Europe. And I think that as long as the virus, as it is that the curve is going the right direction, as long as that's the case, I think you're going to continue to see kind of the economy go back to a function. So those people are expected to go back to work. And I think that's what the market is kind of expecting, which is the news it saw today was the news that it broadly expected, which is, bad, horrible, historically bad. But again, it was expected. And I think that's kind of what you're seeing play out. And that's really been the dynamic. Is we talked about going into April, that we thought that would be the dynamic all throughout the month of April. It was, and this is kind of the capstone to that kind of news cycle.
Great point, Eric. It's not news if it's expected. So second question is around the EU. So the EU is facing a deep recession. What could this mean for the rest of the world?
Well, we should be really careful about that. The world is expecting a deep recession. The U.S. is expecting a deep recession. The Canadian numbers came out this morning too, and they were just as bad, right? Except their unemployment rate only got to negative 13%, which is, that is the ultimate in qualified good news. Europe numbers have been bad as well. Some of the European countries got into the lockdown, like Italy, before the rest of the world did. What you've seen in Europe was last week we saw their first quarter GDP number. It was about negative 4%, which was a little better actually than the U.S. number in the first quarter, which was closer to negative 5%. So, kind of better in the first quarter. Looks like the second quarter is a little tougher, particularly in the services category. What we've seen is kind of PMIs, we talk a lot about, purchasing manager index surveys as a good kind of current barometer of business conditions. And what we've seen, not unexpectedly, right, the market, the economy is closed, and particularly services sectors have been the hardest hit. Interestingly enough, those were the strongest parts of our economy, both in the U.S. and globally, or at least in Europe. The services sector was really kind of the strength of the economy, 4 months ago, and they're just getting devastated, which is not surprising, right? Because we're not actually, we're not actually engaging in services-oriented businesses right now. In the U.S., we've seen a collapse in that services PMI. The collapse in Europe has been a little more pronounced. Some of those surveys, again, 50 is the line of demarcation between expansion and contraction. The services PMI is down kind of in the teens, kind of the low teens for most of Europe. Manufacturing is better than that. The U.S. numbers are a little better than that, but they're not great. And in many parts, things in countries like China and South Korea, numbers are actually getting better. So you've got kind of a mixed bag in terms of when people hit this crisis. So Europe right now is having difficulty, just like we are. I think one of the headlines this week, for instance, the stock 600 index in Europe, European stock index, was up about 1%. The S&P 500 is up about 3%, which basically gets us back to where we were at the beginning of last week. The reality is, I think part of that lag was there was a court ruling in Germany that what the ECB is currently doing in terms of its asset purchase program is illegal. I don't think that's really a serious headline. I think it caused some volatility. But ultimately, I think what's going to happen is a report's going to be written as to why these are necessary. And it's ultimately what the ECB is doing is going to be approved. So I don't see that as a major stumbling block, but it probably gave some agita to the marketplace. Otherwise, I think Europe is largely, kind of in a same kind of pattern as the U.S. It has some advantages. It has some disadvantages relative to the U.S. But by and large, we're kind of all in the soup together. And we're all hopefully going to get better together in the second half of this year. And I think that's still what the market's broadly expecting.
I guess we are all in it together, for good or for bad. Great perspective from the European markets. Thank you.
Yeah, I know that's good news, but yeah, we do have company. Yeah.
So with the amount of stimulus entering the system, we've heard a lot of headlines around the overall national debt.
Mm-hmm.
Is this something we should be concerned about, given that stimulus measures are happening around the globe?
One, it's a long-term concern, but when you're kind of in a situation where you're treating a critically ill patient, you may not care that the scars aren't, the cutting the surgery scars that you're leaving are not exactly, they may be causing some damage. You kind of have to fix those later. You got to save the patient. And I think that's really where the Fed is. That's really where the Treasury is. That's where the entire government in the U.S. and Europe. I mean, let's be clear. I mean, all of these kind of policies that we've been talking about, 13% of the U.S. GDP has been dedicated to fiscal stimulus this year within the last couple of months. In kind of globally, that number is 9%. So sovereign debt's going up everywhere in the world. Ours is going up more than most. Our debt to GDP ratio, which was already moving up because we were running about $1 trillion deficit prior to the crisis. Now that number for the 2020 is probably going to be $4 trillion. Treasury Secretary Mnuchin said that he's going to float $3 trillion worth of incremental debt, which is roughly the size of the package, the fiscal relief package of $2.7 trillion that they passed, plus partly some of just the running deficit. So $3 trillion, when you start doing the number, that 107 debt to GDP ratio is going to go to 120. It's still not what we've seen in countries like Japan, where it's over 200. But it is getting to the area where it's become troubling. And it is something ultimately that the government's going to have to address. And ultimately, we're probably going to have to do a better job of keeping our fiscal house in order and figuring out how to readjust those and potentially start bringing that debt to GDP ratio down, or at least stop letting it grow. But that's more of a chronic medical condition that over time has a cumulative effect. Right now, the goal for policymakers is to keep the U.S. economy alive, and it'll deal with, hopefully we'll deal with the negative impacts of the things that we've done to save the economy. We'll actually do a little bit later. So I think in reality, this is something that is, long-term troubling and something to keep an eye on. But I think, something at this point that is needed for the global economy to survive, the U.S. economy to survive. So I think in that light, it's something, a longer term problem, but not something you need to be really concerned about right away.
Thank you so much for your time, Eric, and your sharing your insights. Thank you all for joining us. We hope you and your family stay healthy and safe. See you next time.
See you then.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.